Welcome everybody. Yep, 1 month ago we did a video on the 3 ETFs that you can buy that are part and parcel of the great inflation trade. That's over here. Let's illustrate it in our legacy. Go back and have a peek if you have the time. 3 by commodity ETFs with the potential to do over 50% surges. So we're going to take a look at those 3 that we mentioned and a couple around it that I didn't mention that was in our community that have since moved on as well, to give you a little bit of an update on the grand macroeconomic situation. Until such a time as a demand destroying event, the commodity trade long is one of the most important games that you should be contemplating trading. Also, we had Stanley Druckenmiller talking for the first time in some while about his great interest in the copper trade, which of course, coming out a couple of days ago, this was of course one of our ETFs that we were discussing. So let's have a look at what Stanley Drux had to say on copper. So without further ado, let's take a look at the tweet around the copper and Stanley Druckenmiller. So that one's over here. We, of course, were talking about the X ETF, copper, COPX ETF that was part and parcel of our video that we did 1 month ago. We were highlighting the potential entry there, and it had just shifted through with a bit of a break. That was now over a month ago, and you can see how it has since moved forward. We'll go into that more on other charts in a minute, but let's have a look at what Stanley was saying. Stanley Druckenmiller thinks copper is a pretty simple story. He obviously agrees with him. Here's the full quote. Copper is a pretty simple story. It takes about 12 years greenfield to produce copper, and you've got EVs, the grid data centers, and believe it or not, munitions. So munitions, the military industrial complex, immense amount of wiring, obviously, and conductivity required. These missiles all got enough copper in them, and the world's getting hot, that we just think supply-demand situation is incredible for the next 5 or 6 years. Ivanhoe Mines CEO Robin Ivanhoe said something very similar in a recent interview. We have 2 competing tribes. This is the left versus the right paradigm. You shouldn't be either, of course. One tribe says, I want to save the world, I'm green, I need cobalt, nickel, platinum, palladium, and copper, by the way. The other tribe says, holy shit, the Army, Navy wants these metals for national defense. So you're either a hawk, military industrial complex feeder, which is very good for the control structure, of course, so you're a useful idiot, or you're a complete green feeder that bought the whole narrative hook, line, and sinker, and are probably jabbed up to the hilt and sending funds to Israel and Ukraine. Anyway, all of those different lefts versus rights, for which you should be neither, all are saying the intensity of metal demand in conflict is beyond wildest imagination. In World War I, you needed a telescope to see the price of copper. So by that he means you didn't need telescopes to fight, you needed to. So we're heading to a world where both tribes have a strong demand for more metals. And you're going to end up with a little bit of both, almost certainly as well, coming in. So interesting one. We actually retweeted Robert Ivanhoe, one of his interviews recently on our profile. So go and have a look. So let's go to the live charts and have a look how it's done. Since then, we got coffee charging. That's all those beeps in the background. So since our release in the video, so let's have a look at the video first of all. People, this is a review of things we've said before you've heard it from Stanley Druckenmiller. This tweet came out, the news before the news. So if you want to follow and trade Stanley Druckenmiller stuff, you should be an HVF method trader trading with the HVF community, because you'll get his trade before it becomes public, well before. We were actually talking inflation trade and copper long before that month that was in there, but that was the last one 1 month ago, and that's the one we're going to go with. So you can go and see our references to hyperstagflation, inflation on a whole spate of videos in our history, most of which are all in and around the great devaluation of fiat and debt, which is one of the big drivers. Anyway, so the interesting story about that is we're just coming up to a second interim, so it's going to go well. The news breaks, everyone's going to wail in, whoosh, couple more ticks to the upside, and then we're going to get our first meaningful pullback. All those that don't do money management, all the retail going to get suckered and smashed a little bit down. You might get a pullback, but the most important point is that in the due course of time, it's our expectation on balance of probabilities that you're going to be running the 66. You're still well sub 50, and when you started right down here, you're 38, and our axis was in and around the mid-30s. Mid-30s to 66, you're almost looking on an early entry at nearly 100%. We put these as 50% plus trades. It's kind of intentionally conservative. These are very good. By the way, that won't mean the end at 66. That'll mean a sustained period, possibly a demand destroying event, a bit of exhaustion and a pullback before going higher in ever further diminishing dollars in this great debt Ponzi scheme that's been proliferated, been expanded, recklessly managed by a cartel of central bankers that are intent on causing a controlled demolition. It's intent, not stupidity. That's an act like they don't know what they're doing and people think they're intellectually superior. This is a planned destruction. To say capital's failed, it's time we have a more inclusive, UBI-centric, CBDC-focused, centralized with fake decentralization options and surveillance finance to solve this situation, the harder edges of capitalism, so that we can ensure that nobody is left behind. Oh, can't you see them nodding their heads and showing you their bleeding hearts as they rape you with that Vaseline finger? Yes, anyway, let's stay away from topics such as that. Let's move on. I did a separate draw, funny enough, over here. And the interesting thing about this COPEX, this is ETF and it's in dollars. So it's not the high grade futures copper chart, and it is dollar, and dollar's been part of the story, relatively firm against most currencies. But don't tell the likes of Brent Johnson and George Gammon that in actual fact the USD Mexican has been collapsing for 3 years in a row, and that comparing it to how strong it's been to the Chinese yuan is actually silly, because China's now set up a workshop in Mexico to export right there. Instead of paying tariffs for being China and being imported, they have now relocated in Mexico and doing a whole bunch of assembly specifically for serving the American markets. And as a result, the good old peso. We should show you that chart. Seeing as we're going to do a sidebar, we may as well do a proper one. Let's do a proper one. We'll say goodbye to the USD JPY. Let's just do that. So if you go MXN USD, that's putting it the wrong way around. That's how many dollars does a peso get you, and you go weekly over here. You will see that in actual fact, throughout this period, you have had the dollar getting weaker to the Mexican peso since April of 2020. So we can all be quite selective about currencies and choose localized lows and then see the benefit of some new strategic move by the Chinese. And listen, I'm not in any great enthusiasm wanting to be falling under a larger Chinese communist system versus the American one. But we've got to stop being overly nationalistic about how awesome the states are. And when I say that, I'm not talking about the amazing citizens, the beautiful country and all the great people. I'm talking about the Fed-controlled demolition that has been orchestrated and planned as end of empire. Everybody goes, oh, fourth turning, it must happen, it's all designed to be. No, people actively broke it, and if you had the right people in there, you actually could have continued for far longer. And as I've said already, I'd rather the hegemony be American than any other nation, if not my own. And unfortunately, that's going to end. And for the American people, they'll find out about the austerity years of the British pound, and the British end of empire, and it was pretty ugly. So, and totally unnecessary, by the way, totally unnecessary. It's not fourth turning. It is the fact that you got people that are actively tertiary extracting, debt proliferating, fiat destroying, unsound money on the basis of stripping the assets and the wealth and putting it into the likes of transnational intermediaries such as BlackRock, Vanguard, and moving with the wealth of the nation, turning it into a larger welfare state for any form of immigrant that can be just literally flown in. Anyway, enough of the politics, but as you can see, dollar hegemony hasn't, while the dollar's generally been firm against most currencies and putting the Chinese yuan in a negative light next to the dollar, kind of doesn't tell the whole story if they've relocated the workshop of the world. On that key point, before we go back to the inflation, China in terms of power, just in coal-fired power, has put in place every year an expansion in coal-fired power that is larger than all of Europe's output, existing output. So every year recently they have been adding in coal fire. That does not include nuclear power. What people don't realize is that most things, even things you think that are made in America, have componentry that is made in China. And they are the workshop of the world. Africa, the entire huge landmass. Another interesting fact, across the bulge of Africa, right the way across to Egypt, is longer than from Moscow to Vladivostok. You wouldn't believe it when you look at the map. The huge landmass that is Africa is only 1% of output. So going and lecturing Africans on green agendas is almost pointless. The only place that matters is the workshop of the world. Everyone else is literally a rounding error. So we have to be kind of careful with this nationalism. Unfortunately, these guys are building the base of everything. And it's not just low value items nowadays. If you want power plants, nuclear power plants I'm talking about, you can forget your Westfields and your French and everything. They will be relying, if you are a big nation state that needs a whole huge new mega nuclear power system with multiple power plants, there's only really Korea and China to talk to that can deliver it. Because it's not just the uranium, it's also the concrete, it's the copper wire, it's the systems, the totally integrated. If you engage any of the Western, they will actually be outsourcing and seeking all the different componentry, and they will actually be almost like a head contractor that will be subcontracting most of that serious work out to the Chinese, Koreans anyway. So such is the way of the world. Such was the comment on the dollar. Back to copper. So given that the dollar had been a little bit of the story, I got the WOKU. That is the World Currency Unit. I hope we won't be hearing too much about it, but somehow I feel they didn't make this thing up by accident. And it is eliminated the dollar effect in this. So if you put the WOKU USD, I actually eliminate the USD out of that because it's copper USD times WOKU divided by USD. The divide USDs cancel each out, and we actually get copper in WOKU, which is World Currency Unit, which is meant to be this aggregated overall weighted basket of the most relevant currencies, a bit supposedly more up to date than the dollar index, which is very Western based, Japan, Swiss franc, a little bit of, I think, Scandi, but mostly euro in it. And as you can see from this is still the same market, but this has a long way to go. You broke out for us around about these levels. Let's get the Koki. It's sub 3 that you would have been breaking out. There's the 3. You could have been entering long anywhere in this early zone for us, which is 2.85, and the overall is 4.43. That's just to target when you're likely to have a meaningful rest. So outside of a major demand destroying event, banks are precarious, lots of things are precarious, so don't underprice that. But outside of that, it is our expectation that you'll be running that. And short of that demand-destroying event being really brutal and running our red line, it's our expectation that given a certain time frame, you will cross that 4.43. It is hyper-stagflation era, and this is deflation, the inflationary part. So how did that copper ETF trade go? Well, we've shown you copper in a number of different formats, but the original copper chart was in fact the COPX that we were using, and from the 38 when we were there, it had already started to walk out. It was low 40s. You are now deep into the final 40s, about to go 50. It is moving in the direction that we indicated. ETF number 1. What else was discussed in that video? Well, we can have a look. We also spoke a little bit on XME, which was mining. So that comes in around here. And the mining sector, we were warning, is going to start eventually turning. Now, this one is one that had already begun. Also a little bit of move. If you want to get these kind of trade setups before it's already started, get the full risk reward, you might want to consider getting into our community. The first link below, book a call. However, you can see roughly where you were in and around there. That was XME. Let's go and see how that one has done subsequently, continuing to fight its way out. So same setup. A little bit later, that was your break. You were around these levels here. It hasn't ripped immensely. It's taken its time to dip back. There was a bit. Then it's made a higher high and a higher low, and we are now currently trading in this level. A second interim performance will be to the 68. We see that running the 85 going 86. Again, a rest and then further is expected. So this is also beyond where it was in the video, and that's in literally a month. Remember, these are trades, and I spoke about how you can do something that you leave on for an entire year and you check the performance. And the best trades in trading, stroke investing, because we're talking about long term, it's not even a trade, you can invest, it could be an investment for a year, is actually wait for the target. It might be a bit longer than a year. It might be a bit shorter that it completes. But is something you set on and forget. And we spoke previously about how you would have got 110% if you'd gone with the Pfizer short, long British aerospace. So military industrial complex, long, short the pharmaceutical, which was now getting all the truth creeping out about all the ins and outs and the excess deaths, etc., etc. Now you're getting into something that is long mining, and it had already broken. Where was it price wise? It's a bit difficult to see. I've gone and put my cursor in the wrong place. I think you're around 60 and you're only marginally higher now, but you went for a little trip around the houses, but it is performing well. So you are still higher at 62, just under 62, but you would have had a pullback. You're working your way up, and at some point I think it gets a little bit more disorderly. We're looking at the gold, silver, and I will finish today on a quick assessment of gold and silver for all the gold and silver bugs. Don't forget to hang on for that because it's quite interesting what's happening there. But here's another one that inside a month has already made good progress. Decent progress. Remember, as I say, you should potentially be taking a 12-month, even a 2-year view on these. These are set and forgets, unless, of course, they run their targets in due time. We have a time stop for this one, and it would be October 25. I would expect it to be done before that, but you would close it if it crosses this purple line without reaching the target, wherever it may be, just because it's languishing slightly. I would still expect it to be upside, but you could be unlucky. It could go past your just-in-time entry, and it could be somewhere here. That would mean it was floundering rather than languishing. But anyway, so making good progress. Another one that inside just a month is up on where you entered it. So let's have a look at what else we discussed. We did discuss Arabica coffee as a soft, but that was just passed by the buy here. We'd done a special separate vid for that. That was an upside HVF. That was 195 that it was. We closed deep in the 200s. Let's go have a look at that. We'll say goodbye to the peso butchering the dollar over the last 3 years as everything now gets made there, which just goes to show I didn't come on here and say every American should sell their dollars and buy the peso. A, nobody would have done it. B, even though it would have worked really well, these are not the kind of things that you can do to reduce your inflation rate easily necessarily. So that some of those discussions that went on, I'm a bit bemused by. Ref, the USD JPY. The yen has been a weakness play. Everybody looks good to the yen. We even showed you those setups for the euro against the yen and many others. So let's bring up the Arabica coffee that we were speaking about. Now it has, we jumped in and we took an immense move. It did show that it was turning, and as a result we took profits some way up. But boy oh boy, did that just give us a beautiful return. So this was that structure from some time ago. Let's drop it down to 12 hours, shall we? And you will see actually this was one that absolutely shot up. And this is one of the benefits of HVF trading, is that once things start to move, they tend to move hard, and they should move hard and strong in your favor. This is now getting a bit rejected a little bit, and the W bottom is being challenged. But boy, oh boy, how well did this do in the initial instance? So that was your setup. Had you traded this for the upside, there we go, it's coming on up, you would have got out over there with 215, having got long at 188. By the time we told you it was in the low 190s, you still had all of that to gain, and it had quite a bit of overperformance. So again, very, very good. Interestingly, there was a post about coffee's average data, not coffee being removed from the CPI calculation, but they will no longer provide the coffee's average data. So how these BLS stats departments work is that they actually go to various different regions of the United States of America, and they buy certain products, by brand, various options, and they get an aggregate of buying coffee, because as you know, you get good coffee, cheap coffee, happy days coffee, coffee with mushrooms, coffee with, instant coffee, various other forms. And I suspect a lot of skullduggery actually happens with brand flexing into the cheaper coffees, etc. And also the average pricing by region will vary depending on whether you're in New York or whether you're in the Midwest. But overall, they are no longer going to provide the data and the costings for coffee. That decision having been made by the BLS, the Bureau of Labor Statistics, that is behind your CPII. Now, when they made that decision, you were facing probably the worst part of this. It has since sold off, as I've said, somewhat. I don't feel it'll be over forever, but because it super ran, I think there's a possibility you could in fact get this pullback for a while, and it'll just underperform and list around these levels for a bit before again commencing likely another move to the upside. So that's true for most of the coffees. We gave you Arabica in the end, which is the most valuable of the beans by nature of its need for temperate climate. So boy, was that a breakout and a great trade. And remember, we have take profits. So you don't have to stay in the trade for a year just because you've committed to a year. If it makes its targets earlier, we'd have take at minimum 50% at the upside HVF's target, and that we did do, and then we closed the rest on the blow off upside once it was clear it began turning. So that was Arabica coffee, which was also part of our inflation trade. And as I say, while it's down now, it's quite clear that it spooked the BLS. They didn't like the number that they might be getting and its contribution to CPI. Most Americans wake up with a cup of coffee, at least one, many have more. So yeah, it's quite an unwelcome escalation in price on coffee. Not to mention, we also showed you in the video the cacao market as well as the Robusta bean. So what else have we spoken of? Well, we spoke of shipping. We spoke of shipping as well. So let's just see if that one comes up. We did the XME. Yes, we did the XME. Silver and gold. Yeah, let's go have a look at the shipping. Now, on the side of the shipping, I mentioned a shipping ETF in there. And the one we'd done inside the community, I didn't show that particular chart in this video, was BOAT, which is a Sonic Shares Global ETF for exactly that, shipping. And this one was only breaking at the time at 32.44. You can see that that's already gone up very, very strongly, and we are expecting out of this 49.55 out of it. Let me just take that off and make it less confusing. 49.55 as an overall move from around 32. That's going to be through the $50 in my view. And as I say, you could have been in anywhere from the 31 up to the 32 level through 50. Another good turn. You're talking about 18 on 32. It's at least 50% with a bit of overperformance, and I expect that to go further. So that is BOAT, which was an ETF on shipping. So those were the things. It's going to get more expensive for you to buy softs, was the point we were making. Copper, which is very strong in building, electronics, Military industrial complex, we did the previous video update on Pfizer and the military industrial complex, BAE, as we mentioned. There's up to 500 ounces of silver in certain missile categories and plenty of copper, and it's not very recoverable after it's blown up, I'm afraid. So all those things borne in mind and part of it. We also, by the way, gave you not so long ago TK Tankers, which was an individual play in shipping. It had already given us a very positive upside HVF over here, there, and made its target there, and wound up again for there, and is on its way, we believe, to 72. So had you started to engage in this one, you would have probably been around November last year, that you would have been getting engaged, or back end of October, and you would have looked initially for the higher level here, which we have as 58.82. So you would have got in at around 44. Now you would be looking at 72.16 on a second wind up. So actually you would have closed this trade probably around here, at least 50% of it. That would have saved you the drawdown of that. You would have been going back long a whole bunch later. The opportunity cost, you would have earned interest on that or had it in another trade for the better part of round about the beginning of 24 all the way through to May. You would have stayed out of that chop, which was only very rarely above your exit price, there and there, most of the time below the watermark of your exit price, and you would have gone back long and you would now be there. 68.47 currently on entries that would have started around 42.85 up to 44, 43 to 68. So actually, in terms of this, talking about 50% gains in a year on this, you already would be done with an over the 50% return here in well less than that. So October of last year, October's still some way away. We're in the 5th month. October's another 5 months, and you're close to your 50. In fact, you're through your 50% at 68 on 44. 22 on that is 66. You've made your 50%. You're actually looking for 72. And then you'll close again and you will have your money back before October in my submission. So that's another overperformance to 50% on a particular equity, but you could of course stay in the ETF and play the general field. Big player in shipping. So this has got to do with your soft commodities. It's got to do with mining and metals. Industrial metals, obviously, with copper being discussed, and mining generally, for metals both precious, semi-precious, and just hard industrial metals, and your shipping thereof, and all goods that you buy at end purchase levels for the your consumption and your entertainment, your toys, your cars, and everything else. And of course, the bigger industries such as the military industrial complex, which we've mentioned already a couple of times, and mentioned that it's a winner and a big consumer of copper, along with a green agenda, ergo the left versus right story that we read you in the tweet. Both need the metals. Both need the metals, and both are going to get fed. We're going to pursue the watermelon communism green agenda, and we're going to pursue all-out war. In fact, there's talk with Brigden, an MP that was discussing the jibby-jabby, and he was saying officially we're essentially already at war. The UK is already at war with Russia, sending lots of special agents, advisors. I remember that during the Ukraine 2014 Maidan events with snipers shooting on the renter crowd that Newland organized. So we're already deep in that territory in Ukraine, as is the French, who actually out and out bragging that they're sending soldiers. These commitments are going to get bigger and larger. Russia did on the borders a nuclear drill. I really fear that these people are inherent on some serious population control and a real need to pump the bags of the military industrial complex, which of course is going to lead to further need for the likes of copper for one. What does this mean, by the way, for our friends silver and gold? Well, we also referenced in that video silver and gold. So let's just go back because it was 1 month ago. It helps to take stock of where you were then and how you are now. And if we go roughly to this part of the video, we started talking about silver potentially being in a breakout point. We spoke many times on precious metals about that capping descending grind line and said this could be the first time we are truly breaking that, and that could see a move up to the levels close to localized all-time highs of the last 4 or 5 years. We're not talking the $50 in 2011. We're talking recent Wall Street bets, the highs of the gold high here, these localized highs as they were. At the time you're at 25.42, and certain people were saying there goes silver, just done its annual pilgrimage to 25. What actually happened is silver did a bit of a pilgrimage beyond 25, shock and horror, and actually turned out to be doing far better than many thought. So if we go to that time frame, I need to replicate it. Maybe it was a weekly. And let's just switch the lights off of all my work on there. So we had that descending, capping descending grind line that went something like that. And you're like that down there. And there we go. This has been a long old continuation pattern. Well, you were just there and breaking. You surged forward. You had your mandatory pullback return move, and you've had another strong candle. We are, of course, Monday. It's the beginning of a new week. This is a weekly chart. It's very little data. That candle is almost meaningless for now. We haven't even had a close of the 1 day. But as you can see, at one point we came perilously close to the very important level that I see, that is 30. So of the key levels of significance, that is price points, breaking and holding above the 30 level will be seminal. Let's get that drawn on the right place, roughly there, which was real resistance there. It was resistance there, although you technically traded through it. So the approach from the 29 to the 30 is a soft to a fairly hard ceiling point, and we've rushed right up to that, and understandably we got blocked by the markets, let's just say, as a resistance point. And remember, now this one is one we've been blocked at twice, so this is the third time, and once, twice, 3 times, and the next time will be your lady, an interesting lady, I think one that will break quite strongly to the upside. So the L comes next. We'll see if that is coming soon, but also it's quite clear that since this breakout we were actually quite correct capturing the key break of the descending grind line that ran through those localized highs. Silver is significantly higher, and the pilgrimage was not to $25. The pilgrimage was to the doorstep of 30, which is another key technical test, which means we've tested 3 times, which is great progress. It thins the sellers out for the eventual break, and the eventual break will likely be with momentum. So it's very difficult to talk about silver. Gold had already broken without also the gold silver ratio coming into the discussion as well. Here is gold. Now gold has pulled back a little bit harder. We said it would pull out of pump after its falling wedge. Let's take that up to an hourly instead. So there was the falling wedge down to the 2,300 technical run. It started to square up here on the 2,300. You'd had your 3 impulses. We warned that we felt that this was 3 clear impulses you were going to break here, and that did in fact occur. You had a very restrained pullback that was flag-like, and our suggestion was you would make a bull flag move higher before resting again. This turned out pretty accurate. You didn't go much beyond, and the pullback has actually been quite abrupt. We've just had a little pop of dollar strength, by the way. That's why you saw the USD JPY with that little ping upside. And that means a slightly deeper dip for gold. However, when we look at the silver chart on the same time frame, so we were on an hourly, I believe there. If we have a look at silver during this period, it's had a little bit better go of it than gold. It also had a falling wedge, which we've drawn like that. It also squared up a little bit. When gold was having its flag, it pulled back. But what we did highlight is that you had an inverted head and shoulder in that on silver. So we highlight the left shoulder with the armpit, the full-blown head there, the second armpit for a lighter and shallower right shoulder, and you have now begun progress to a pilgrimage to the $29. So that is pretty good. And of course, you've had a pullback and you started to work your way up and around. We've just had that stab of dollar strength, which has brought in that one selling candle. We'll see if it finishes there. I'm not so sure that it will. It's getting a little bit of pushback already. 29, and then probably again, I think a little bit of rest and respite before making further upside. So that was, let's have a look at how that looks on the gold-silver ratio, if we can. That is not it. That is gold in Swiss francs. So why did gold pull back so hard? Well, gold kind of made a number of targets recently. It's done quite a lot. This is gold against the Swiss franc. This was a target we had for it for 2,133 in francs. The franc is stronger than a dollar. Another currency beating the dollar generally over most time periods. As well as gold, which is real money that's been beating the dollar. So as I say, dollar will be firm against most fiats, but that doesn't mean it's omnipotent. So anyway, yeah, so it needs to churn and pull back a little bit and shake its head. It's had a very, very good and super fast impulsive move. By the way, in terms of time, it had up until here just to get to 1989. So the time allowed was that gradient. It's got all the way to the target, and our time stop isn't even in view. Our time stop is some way away. Bring it up, bring it up, bring it up. It's just killed it. It's done it in about 1/10 of the time. Here we come, I'm coming on. One more. Where's that time stop? I think that time stop's gotten a little bit too, there it is. Sorry, what am I talking? There it is. It had till the 16th of February 26 to do it in it, and it was done in a blink of an eye, around about 5 or 10% of the allowable time. So this is what's typically happened. So, you've just sprinted 100 meters. I mean, it's not the time to then give it a marathon to do. Let it sit down, have a break, and that's what it's going to do. So gold has done well, but it pulled back a little bit harder, as you were seeing, after its bull flag performance that we were just referencing there. So what's happening on the gold-silver ratio, the gold-silver ratio? Well, what I'm going to do is just show you that little bump in the dollar strength, which is weakened quite badly over there. It had a bad non-farm payrolls, then had which you'd already broken out of. By the time NFP came, you'd already fallen from there to there. We had a rising wedge fall. You broke out of that there again at the 105. You went flag-like, you're softening, and then you've spilt again. Had a little bit of a bump for the return move. But this is an easing period. On this time frame, we're on a 30-minute time frame. Generally, I'm seeing the Dixie going up and recovering, but it's not going to kill the rest of the other currencies. It's marginally better, but right now it's in a weaker phase because they're looking at how many cuts, and they've gone from wanting 7 cuts going into this year when we said that quite possibly that you might get none or 1 or 2. And now you're in a situation where those expectations are well down and they're now talking the 1 or 2 type levels that we warned originally. So the economy has slowed. It was a bad misses on the non-farm payrolls. So dollar doing that. So let's get up for you the gold-silver ratio. So gold, we're going to take the gold futures chart and we're going to divide it by the silver futures chart. So we get another copy up there, divide it by the silvers, and we will show you that in actual fact, as you can have seen, that silver is in fact doing slightly better than gold. You saw our gold slipped a bit there after its bull flag target to the upside. So it's interesting to see. This is typically a chart best viewed on a weekly time frame, and of course we're Monday. So to get too zealous and stroppy about a move so far on the Monday is getting a little bit ahead of yourself. This is the key bit of technical behavior I want you to keep an eye on here. These over here, we've been in this range-based gold-silver ratio for quite some time. Every time we've approached the dashed red line over here, there's been a respite. There's very few candles on the week level that closed below this. This is on the line, not through it. Nothing has closed on it. Currently, if the week ended today, which is very presumptuous, it's only Monday, you would be closing below this, and this would be the first technical break. And we've spoken about the two key triggers for the major advance in precious metals. We spoke about the yield curve inversion. We've spoken about the gold-silver ratio triggering, and we also spoke about the capping descending grind lines breaking on gold and silver. Gold is already broken. I've now shown you that silver is already broken on those two. You await this, and then for the demand destroying event, you await the reversion back positive of the traditional yield curve. So we have a lot of triggers that we're monitoring for when various things might happen. At the moment, this represents some silver overperformance, even though it's still very high at 82. It's this grinding upward line that will keep continual pressure. And if we were to fold on that, that could go into a capitulative move to the downside. Probably 65 would be the next level that it would drop to. This would represent real overperformance. So we started talking about copper. Now copper is conductive, silver is even more so. Copper is looking like it's going to get more expensive. So you have gold, well, you actually have some of the palladiums, platinums and rhodiums that are rarer than gold, not all priced more than gold. At one point rhodium was in the 30,000s, now it's 1/10 of that. Platinum is actually cheaper than gold, and even palladium is cheaper than gold. So gold is actually top of the tree now. Why? Financial substitution for US treasuries is my take. Hence why rates are to stay higher for longer and cuts will be less, because the biggest buyers in the room are moving away. They're buying gold. That's what's happened. Preservation of capital for the event. They're buying gold. That's put gold at the top of the tree on the precious metals by price at the moment, although not the rarest of the precious metals. Silver is probably the cheapest of the precious metals, just making the precious metals cut, and copper is sort of at the top rung of the industrial metals that are semi-precious. In China, they keep copper actually much as people would keep silver here as a monetary metal as well. So with copper to go up and gold already showing it's going up, the notion that silver will languish from its all-time highs forever is not possible. Remember, if silver is relatively cheap, it conducts even better than copper for high-value armaments, industrial tools. So it will need to retain a strong premium over something like copper, and reaching distance also to gold. So while it can get relatively cheap inside its younger, cheaper sister, the industrial copper, and its bigger brother, the heavy priced gold, it's unlikely that it will be able to move too far in on any one side on that parentheses until we get complete disorderly markets. So the bullishness of copper is going to be longer run bullish for silver. The bullishness for mining and the fact how difficult it is and how long it takes is going to be very positive, feeding both the left and right people's agendas, whether they are justified or valid. In most instances they aren't. They're foolhardy and stupid, but stupid is as stupid does. And we're going to get a whole bunch of Bolshevik stupid with the template framing of the left and right playing their story out. In terms of everything else, you've got your softs that have been very, very strong. That some of them are in pullback state at the moment, yes. And you've got very expensive shipping. So these are where we stand. Boat, TK tankers, the copper, and everything else. So you would be broadly up within a month on all those particular trades, and some of them already having made their 50%. Think TK Tanker in terms of its performance so far. So for you, how do you build wealth in reset times? What does this come down to? You really need to understand the macros and get the macros right. And you have to understand what hyperstagflation means. There's stagnation macroeconomically for the retail market, the bubble, the twisted balloon economy. One half is being pumped all the air, the other one is getting all the release out. The air released out of it. That is us, the retail man in the street, actually feeling quite tough times, high prices, salaries aren't matching, negative real wage growth, negative real returns on bond and investment instruments, pensions underperforming, all of which affect retail. On the institutional side, you have the likes of the military-industrial complex absolutely gorging on massive amounts of government-sanctioned expenditure on the military-industrial complex, plus the proliferation of currency, those arms to the likes of Israel, Ukraine, and everybody else, as well as rearming their own nation states, lots of testing, lots of chest beating, and a lot of scaling up in the military front. So that right-wing part of it is certainly going to get a lot of juice, a la the BAE video that we did. You need to understand these things. You have to preserve yourself, you have to preserve your finances, and you have to look after your family and build wealth during these times. This is our core and special focus. The way you engage with us to trade many of these things, so you too can have a his and her trade, like the Pfizer BAE trade that we showed you, that's going to make you a quiet 110% over the course of a year without you having to do very much. Just have your targets, your entries in, and let it play. The money is made in the sitting, not actually in the order entry. This is not trading. The patience and the sitting with a plan, with real reasons, a stop, a target, and a level-headed entry with a massive asymmetric reward to a very tight risk is how you build the wealth. That's what you need to understand, and that's what this channel is all about. And if you've got this far, you're probably one of our guys, because most people don't watch right to the end. If you've got this far and you've heard this message, it means you understand what I've just said. And for that, you need to click the link below and book a call, because we're here to help you get wealthier in what is going to be a very polarizing event. People you know are going to become working poor. They could be upper middle class type people right now, but it may all be on leverage, it may all be on debt, but they will eventually end up very poor because they've made bad financial decisions. You have the power within you to change your course of your future by doing the right things. And I would suggest this is probably the single most important things, because fortunes are going to be made as fast as fortunes are going to be lost during this period. And positioning is everything. And part of this series is also showing you that many of the macro key threads that we are putting out are standing up. They are moving into the green inside 1 month, and over a year they are almost doubling your capital. That's not involving some meme coin on crypto to get you that performance. It is real sound big companies paying real dividends with real markets that are achieving that for you, and it won't all be lost because some exchange went bust or various other things. Besides all that, there is real counterparty risk that you also need to prepare for, and we cover under our reset banner. Thank you for listening. We appreciate you, and we'll be back on our travel show, so you'll see me from the laptop and everywhere else. I look forward to checking in with you, but this was your update on the 3 key inflation trades that we gave 1 month ago. Well, how do you think we've done? What do you think will be the biggest mover of them all? Let us know in the comments below. We read every single comment, and we often reply to many of them. We keep a really clean comment section by deleting all the spam. It's really interesting to us what you guys think. Thank you for watching. Bye for now.